Chapter 12, Inventories and Cost of Goods Sold. The term inventories is used in this chapter to include goods on hand ready for sale, whether the merchandise is of a trading concern or the finished goods of a manufacturer, goods in the process of production, and goods to be consumed directly or indirectly in production, such as raw materials, purchased parts, and supplies. Second, probably only to revenue, frauds involving inventory are one of the most common types of management fraud. This is partially due to the ability to both lower cost of goods sold and increase ending inventory by overstating the valuation of the ending inventory, thereby increasing net income and current assets at the same time. Counting of the inventory may also prove to be a difficult task if the inventory is scattered and moving, such as with cattle on a ranch, and can require a specialist, such as in the case of the diamond inventory in the audit of a jeweler. The audit objectives in auditing inventories and cost of goods sold include the use of the understanding of the client and its environment to consider inherent risk, including fraud risk, related to inventories and cost of goods sold. The auditors should obtain an understanding of the internal controls over inventories and cost of goods sold and assess the risk of material misstatement when designing tests of controls and substantive procedures. The substantive procedures shown in this slide will be discussed in more detail later in the presentation. The responsibilities of independent auditors with respect to the validity of inventories can best be understood by considering the rather spectacular McKesson and Robbins fraud case. The hearings conducted by the SEC in 1939 disclosed that the audited financial statements of McKesson and Robbins, Inc., a drug company listed on the New York Stock Exchange, contained $19 million of fictitious assets, about one-fourth of the total assets shown on the balance sheet. At that time, auditing standards were limited to an examination of records only and did not require any observation, physical count, or other actual contact with the inventories. Subsequent to this case of fraud, the AICPA issued statements of auditing procedures 1 and 2, the first formal auditing standards that affirm the importance of the auditor's observation of physical inventories, but authorized the substitution of other auditing procedures under certain circumstances. The importance of adequate internal control over inventories and cost of goods sold from the viewpoint of both management and the auditors can scarcely be overemphasized. The control environment reflects the overall attitude, awareness, and actions of management and the board of directors concerning the importance of control and the way it is used in the entity. The aspects of the control environment that are particularly relevant to the auditor's consideration of the inventories and cost of goods sold include the commitment to attract, develop, and retain competent employees. There should be appropriately qualified and trained personnel assigned to purchasing goods and services and receiving and storing the goods. A commitment to integrity and ethical values is of extreme importance to prevent fraud. If purchasing agents accept kickbacks, the company not only will lose the amounts accepted, but may make purchases of substandard goods or pay excessive prices. Internal control is improved when the client's organizational structure is appropriate and when levels of authority and responsibility for purchasing and production activities are clearly communicated. It is especially important for personnel involved in purchasing, receiving, and production to understand their responsibilities for the application of controls. The risk of material misstatement of inventories and cost of goods sold is reduced when management evaluates and manages the risk related to purchasing and producing goods and services. Aspects of concern to the auditors include management's assessment of risk related to the availability or a supply of goods, services, and skilled labor, stability of prices and labor rates, the generation of sufficient cash flow to pay for purchases, changes in technology that affect manufacturing processes, and the obsolescence of inventory. Relevant monitoring controls for the purchases cycle include management's review of reports for purchases from suppliers, inventory on hand, and accounts payable balances. Monitoring controls can include the use of software to monitor purchasing transactions to identify unusual transactions that may be in error or fraudulent. The controls for production include observations by production supervisors of the performance of various activities and functions, and quality and performance reviews. Management should also have a formal process for considering recommendations by the internal auditors for improvements in the purchasing and production functions and the related control activities. Purchasing, receiving, storing, issuing, processing, and shipping are the physical functions directly connected with inventories. The cost accounting system and the perpetual inventory records compose the recording functions. Since the auditors are interested in the final products of the recording functions, it is necessary to understand and evaluate the cost accounting and perpetual inventory records, as well as the control activities and documents underlying the preparation of financial data. Strong internal control over purchases ordinarily involves an organizational structure that delegates to a separate department of the company exclusive authority to make all purchases of materials and services. The purchasing, receiving, and recording functions should be clearly separated and lodged in separate departments. A purchase transaction begins with the issuance of a properly approved purchase requisition by the stores department or another department needing the goods or services. The purchase requisition provides the basis for preparing the serially numbered purchase order. In many large organizations, purchase orders are issued only after compliance with extensive procedures for determining the need for the item, obtaining competitive bids, and obtaining approval of the financial aspect of the commitment. Copies of the purchase order should be forwarded to the accounting and receiving departments. The copy sent to receiving should have the quantities blacked out to increase the likelihood that receiving personnel will make independent counts of the merchandise received. The receiving department is responsible for the determination of quantities of goods received, the detection of damaged or defective merchandise, the preparation of a receiving report, and the prompt transmittal of goods received to the stores department. The stores department first counts, inspects, and receipts the goods delivered to it, and then notifies the accounting department of the amounts received and placed in stock. After signing for the goods, the stores department is responsible for the physical security of the items of inventory received. The stores department, being responsible for all goods under its control, has reason to insist that a pre-numbered requisition be issued for all items passing out of its hands to serve as a signed receipt from the department accepting the goods. Overall production should be controlled with a master production schedule that presents the gross production needs for a particular period. Once the required resources are determined to be available, production orders are prepared to authorize the production of specific products. Materials requisitions and move tickets document the flow of the goods and related responsibility as they progress through the production process. Job time tickets are prepared to document the labor or machine hours devoted to a particular production job. Shipment of goods should be made only after proper authorization has been received. This authorization will normally be a sales order approved by the credit department. The shipping department will prepare, or the computer system will generate, a pre-numbered shipping document indicating the goods shipped. One copy of the shipping document should be retained by the shipping department as evidence of shipment. A second copy should be sent to the billing department as basis for invoicing the customer, and a third copy should be enclosed as a packing slip with the goods when they are shipped. For goods shipped by common carrier, a fourth copy of the shipping document, required in this case to be a bill of lading, is provided to the carrier. As Adequate cost accounting systems is necessary to account for the usage of raw materials and supplies, to determine the content and value of goods in process inventories, and to compute the finished goods inventory. This system comprises all the records, orders, and requisitions needed for proper accounting for the disposition of materials as they enter the flow of production and as they continue through the factory in the process of becoming finished goods. Perpetual inventory records constitute an extremely important part of internal controls. These records, by showing at all times the quantity of goods on hand, provide information essential to intelligent purchasing, sales, and production planning policies. The use of a perpetual inventory system allows companies to control the high cost of holding excessive inventory while minimizing the risk of running out of stock. An IT-based inventory system makes it much easier for the client to maintain control over inventories, purchase requisitions, and orders when inventory levels reach predetermined reorder points. The client's purchasing system may even be linked to the system of its suppliers, allowing electronic data interchange to completely coordinate production and purchasing. In the risk assessment phase of the audit, the auditor uses their understanding of the client and its environment to consider inherent risk, including fraud risk, related to inventory and cost of goods sold. They also will obtain an understanding of the client's internal controls over inventories and cost of goods sold to assess the risk of material misstatement and design future audit procedures. This chart lists potential misstatements of inventory and examples of possible errors and frauds for each, with the internal control weaknesses or factors that increase the risk of the misstatement. Inventory cost and quantities are subject to errors and fraud that can result by simply not counting inventory quantities correctly or by fraudulently failing to write down obsolete inventory. These errors and frauds can be associated with the lack of effective internal controls in the control environment, cost accounting systems, database or computer systems, and physical controls over the inventory. The misstatements of early and late recognition of purchases or cutoff problems can be either due to errors relating to ineffective production or supervision of inventory or accounting procedures, or in cases of fraud from ineffective controls in the control environment. After the auditors have obtained an understanding of the client and its environment and the controls implemented for inventory, they will determine whether they will rely on the internal controls, and if so, perform tests of controls for operating effectiveness. Some examples of these would include examining a sample of purchase transactions for significant aspects such as comparisons between the purchase requisition, receiving reports, vendor invoice, and check for each purchase in the sample for accuracy and proper approval. The auditor may test the client's cost accounting system to determine that the three elements of manufacturing cost, direct materials, direct labor, and manufacturing overhead, are allocated to specific jobs or processes and are appropriately compiled. Based on the results of these tests, the auditor may revise the risk of material misstatement. This slide lists the internal controls for the conversion cycle and the typical tests for each of the policies or procedures with the associated audit objectives or management assertions. The auditor will then begin the substantive part of the audit program for inventories and cost of goods sold. The first step is to obtain listings of inventory and reconcile them to the ledgers. Next, the auditors will evaluate the client's planning of physical inventory, observing the taking of physical inventory, including making test counts, and then review the year-end cutoff of purchases and sales transactions. The auditor will obtain a copy of the completed physical inventory, test its clerical accuracy, and trace test counts. The auditor will need to evaluate the basis and methods of the client for inventory pricing and test the pricing of inventories. The auditor should perform analytical procedures and determine whether any inventories have been pledged and review purchase and sales commitments. Last, the auditor will evaluate financial statement presentation of inventories and cost of goods sold, including the adequacy of disclosures. This slide lists the substantive procedures for inventory and cost of goods sold and the primary audit objectives and management assertions for each. It is not the auditor's function to take the inventory or to control or supervise the taking. This is the responsibility of management. The auditor's responsibility is to observe the inventory taking. However, to observe the inventory taking implies a much more active role than that of a mere spectator. The auditor should determine that all items were included and that employees complied with all of management's instructions for the count. Throughout the process, the auditors seek to determine that all usable inventory owned by the client is included in the count, as well as to be alert to the possibility of inclusion of any obsolete or damaged merchandise in inventory. The auditors will also record the serial number of the final receiving and shipping documents issued before the taking of inventory so that the accuracy of the cutoff can be determined at a later date. The auditors will make test counts of selected inventory items during the inventory observation. The extent of the test counts will vary widely depending on the level of the risk of material misstatement and the materiality of the client's inventory. If the inventory does not already have barcodes, radio frequency identification tags, or other types of identification tags, serially numbered or computer-generated inventory count tags are usually attached to each lot of goods during the taking of a physical inventory. A company desiring an independent audit should engage the auditors well before the end of the year so they can participate in advanced planning of the physical inventory and be prepared to observe the actual counting process. If this is not possible, the auditors may conclude that sufficient appropriate evidence cannot be obtained concerning inventories to permit them to express an opinion on the overall fairness of the financial statements. On the other hand, under other circumstances, the auditors may be able to obtain satisfaction concerning the inventories by alternative auditing procedures. These favorable circumstances might include the existence of strong internal control, perpetual inventory records, availability of instructions and other records showing that the client had carried out a well-planned physical inventory at or near the year end, and the making of test counts by the newly appointed auditors. If the auditors are to express an unqualified opinion, their investigation of inventory should include some physical contact with items of inventory and should be thorough enough to compensate for the fact that they were not present when the physical inventory was taken. An accurate cutoff of purchases is one of the most important factors in verifying the existence and completeness of the year-end inventory. The auditor's approach is to examine on a test basis the purchase invoices and receiving reports for several days both before and after the inventory date. In this process, the auditors will determine that the liability to suppliers has been recorded for all goods in inventory. The primary purpose of cutoff procedures is to make sure that shipments and purchases of goods are recorded in the proper period. The auditors are responsible for determining that the basis and methods of pricing inventory are in accordance with generally accepted accounting principles. The investigation of inventory pricing often will emphasize the following three questions. What method of pricing does the client use? Is the method of pricing the same as that used in prior years? Has the method selected by the client been applied consistently and accurately in practice? To answer the last question, the auditor should test the pricing of a representative number of inventory items. This slide illustrates a computerized audit work paper for testing of inventory pricing for raw materials and purchased parts. The listing shows part numbers and descriptions for the items chosen for testing with the inventory quantity, price, and related vendor invoice information, including name, date of purchase, invoice number, quantity purchased, and price. The auditor will then compare this information to the actual vendor invoice for agreement, noting the procedure by tick marks and giving appropriate conclusions, an auditor's signature and date of performance. This slide illustrates some of the tests that may be performed using data analytics to identify areas requiring additional audit attention to prevent potential misstatements and possible fraud in the inventory accounts. One of the most important factors in proper presentation of inventories is in the financial statements is disclosure of the inventory pricing method or methods in use. Other important disclosures include changes in methods or valuing inventory with the dollar effect and justification for the change reported, the various classifications of inventory such as finished goods, work in process, and raw materials, the details of any arrangements relating to any pledged inventory, the deduction of valuation allowances for inventory losses, and the existence and terms of inventory purchase commitments. In the initial audit of a client, the auditors may not have been present to observe the taking of inventory at the beginning of the year. What procedures can the auditor follow to obtain evidence that the beginning inventories of the client are fairly stated? The first factor to consider is whether another CPA firm audited the client for the preceding year. If a review of the predecessor firm's working papers indicates compliance with generally accepted auditing standards, the new auditors can accept the beginning inventories with a minimum of investigation. If there was no satisfactory audit for the preceding year, then the auditor would first have a discussion with the person who supervised the physical inventory at the beginning and study the written instructions used in planning the physical inventory. Then the auditor would trace numerous items from inventory tags to final summary sheets and test the perpetual inventory records from the previous year by reference to supporting documents for receipts and withdrawals. Last, the auditor would test the overall reasonableness of beginning inventory in relation to sales, gross profit, and rate of inventory turnover. And this is the end of the presentation for Chapter 12.